In this lesson, we're going to go over how to check the fees and their performance in different investment funds that you may be considering so that you can make an informed, educated decision about what are the best investments for you to be purchasing. Now, what we're going to go over, you can do with any type of investment. So any fund that you're looking up, checking out, look at these two things. These are two of some of the most important things you want to be analyzing when you're making a decision about what to invest in. The fee, which is also called the expense ratio, and also the performance, which is basically how the investment has grown over time, and comparing that to other types of investments to be able to determine whether it is a strong investment. Now we're going to be looking at the ETF for VTI as well as the index fund for VTSAX. Now these are the total stock market funds in Vanguard. So they're good funds to compare other things to as a benchmark, because we know on average the past 100 years that the total stock market has grown at a rate of about 7 to 12% on average for 100 years, which is extremely difficult to beat. It's very, very good. And also these funds have very low fees or expense ratios in Vanguard. So I'm going to walk you through and share my screen how to check out what that fee is and performance rate for these funds. And then you can do the same thing for other funds that you're looking at to be able to compare. Let me go ahead and share my screen. All right, we'll start with the ETF version, which is called, the ticker is VTI. Now to find this page, I just literally typed VTI into Google, and this was the first thing that came up, which it's basically the page for the fund on Vanguard's website, and they have a similar page for all of their different funds that you can purchase through Vanguard. If you're using a different platform, a different broker such as Fidelity or Charles Schwab, it's going to be similar. You'll type in whatever the version of the ticker is for that brokerage firm, and then be able to look up their page and look for similar things. So the first thing we're looking for is the fee, which is called the expense ratio. Now, when you get to this page, there's a lot of different things to look at. You might feel overwhelmed. So what you can do is click on your keyboard, if you're on a computer, is put Command F or Control F, depending on what kind of computer you have, and type in expense ratio, and you'll see it pops up right there. So this is where we will see it. Again, the expense ratio is the fee of what you'll be paying to be investing in that fund. You can't invest in anything completely free. There's always some kind of fee associated for the cost of managing the fund. The key is to get it as low as possible, because those fees can really add up over time, right? And if you were to be using a financial planner to manage your fees, there could be fees something like 1%, 2%, or even higher. Those fees can end up being hundreds of thousands of dollars over a lifetime. NerdWallet actually has a study showing that a 1% fee, I believe over 40 years, would end up being over $500,000 that you would end up paying to that financial planner for that fee. So that's why it's so important to learn to be investing on your own, so that you don't have to pay high fees for the planner, at least when you're starting and setting the foundation of your investment plan. And also why you want to make sure the fee is as low as possible. So this rate, 0.03, which is the current expense ratio for VTI, is extremely low. It's pretty hard to get lower than that. You may see in some places something like 0.02, but this is an incredibly competitive low fee. This is one of the reasons why Vanguard is a great place to be investing, because they have really low fees. They're the only investment firm I'm aware of that is owned by the investors. So they don't have an incentive to make the fees really high. Their incentive is to keep the fees as low as possible. So when you're comparing investments, compare it to this 0.03 as a benchmark. If it is 0.03 or lower or a little bit over, that means that it's a pretty competitive fee and something you want to try and stick around. If you're looking at some that are a lot higher, like getting close to 1% or way above 0.03, it doesn't mean necessarily that you shouldn't invest in it. You just want to have that knowledge when you're making the decision. So for example, if you wanted to be doing a socially conscious fund that has a higher fee, you might say, I'm willing to do this because it's important for my values to be investing in a socially conscious fund. If you want to learn more about that, we have a lesson on socially conscious funds you can check out. But it's really a personal decision, all of this. We just want to make sure that you're making an informed decision. So knowing that fee, knowing what you're getting into is super important. So that's how you find the fees. Pretty straightforward, right up at the top of the page there. Now let's look at what the fee would be for VTSAX, which I have in the next tab. Again, I just typed VTSAX into Google. This was the first page that came up. This is the Vanguard Total Stock Market Index Fund. So it's really similar to the VTI ETF. It's just structured a little bit differently as an index fund. And you can see in the same spot up top, they've got the expense ratio. Here it's 0.04%. So it's slightly higher, just a little bit higher than the VTI, right? Doesn't make a huge difference between 0.03 or 0.04. I would say they're pretty comparable. They're both very low and very good. I will note that the difference between these two funds, and you'll see this a lot on Vanguard with ETF versus index funds, is there is a minimum investment for the index fund version of $3,000. What that means is that in order to get started investing in VTSAX, the first time you purchase it, you have to put in at least $3,000 to get it open. And then once it's open, you can put in as little or as much as you want. So you can put in $1, $5, you know, $400, $1,000, $2,000, whatever you want to do whenever you're investing in it. Once you pass that 3,000 mark in the beginning, you put as much or little as you want. Compared to the ETF, I'm going back to VTI. When you're purchasing that, it's based on what the price is that day of the ETF. So the ETF you can think of as like a slice of the index fund. So instead of buying into the whole index fund with VTSAX, in the ETF version, VTI, you're buying like think of it as like a slice in the pie of it that you own, and it's whatever the cost of that slice is on that day. So at the time of recording, you can see that the price down here is $222.13. So if you wanted to buy an ETF of VTI, you would have to have $222.13 to buy one slice or one ETF. And then if you wanted to buy two of them, you would buy that times two. If you wanted to buy three, it would be that times three, and so on. So if you don't have the 3,000 yet to get started with the index fund version, I just went back to a VTSAX. What you can do, going back to VTI, is start with the ETF version and save up till you have $222.13 and buy one ETF, and then you can buy another the next month, and then another the next month, and keep doing that. At a certain point, the value is going to get to an amount of at least $3,000. And you can either just keep doing ETFs, buying as many as you want, or you can call up Vanguard and ask them to switch it over to the index fund version, VTSAX. Either one is totally fine. The main advantage of switching it over is that if you're in the index fund, you don't have to buy what the amount is that day. Like let's say you wanted to just put $50 in instead of having $222.13, you could do that. Or if you want to put in more, if you wanted to do $500, you can do that. Totally your choice which one you want to do. But to get started, if you don't have 3,000 ready to invest, going with VTI would be a way to do this if you wanted to do total stock market funds. Anyway, I digress. So now we've covered at this point how to see what the fee is through the expense ratio. Now, the second thing I wanted to go over is how to see what the performance is, so that you know how the performance is, what the interest rate you could expect, which is the amount of growth from the fund, right? Because the whole point of investing is for the money to grow. And when it's the amount that's growing is the amount on top of what you've put in that you're earning. It's also referred to as earnings. It's basically the free money that you're getting from the investment company as a thank you for investing with them. And so here's how you look at the performance. So you go to the tab right here, price and performance. wait for it to load. And then there's a whole bunch of data that you can look at to see their performance. The most relevant, I think, thing I like to look at is down here, the average annual returns, and then looking at it, around 10, how it's performed over 10 years and how it's performed since inception, since it was started. So if we look at 10 years, the average performance here for this fund, right, has been about 16%. That's extremely high. So remember I said the average rate of return of the total stock market over the past 100 years is between 7 to 12%, right, on average. So this is way higher than that. That means this fund has been performing really, really well in the past 10 years, and it's gone way above the average. Now, keep in mind that over time, the stock market is increasing, right? Like this, it's increasing, and it's averaging out. In the short term, it's going up sometimes and down sometimes, and up sometimes and down sometimes, right? Totally normal, right? For it to go up and down is part of the cycle of the market, right? But it's going to average out over the long term. So we want to get an idea of what this fund you're looking at is going to look like over the long term, so that you can know if it's going to be keeping up with that average 7 to 12%. Now, 16% is looking at only the past 10 years out of that whole picture of like 100 years that we are comparing to at that average 7 to 12%. So it's likely going to go down when we get into a longer period over 100 years, because 10 years is relatively short, right? If you're investing for long-term, building wealth for retirement, for your kids' college, your kids' future, that's going to be over decades. And that's what we're interested in. How is it going to perform over decades for building generational wealth? So we can assume that this fund is doing well because it's been way above the 7 to 12% range, and closer to 16% in the past 10 years, right? But to understand how it may look like more over 100-year period, we want to look at since inception. Now, this fund has been open since 2001. So that's over 20 years at the time of this recording, right? And so when we look at a longer period, that's way longer than 10 years, it's over 20 years. Now you can see what I was talking about, where it's going down closer to 9% of the rate of return. Now that's starting to fall more in what we expected, in that range on average of 7 to 12% over the past 100 years for the total stock market. That's like pretty much in the middle of that range, right in the middle. And so that's good. That's what we were expecting. That's a very, very strong rate of performance. That's way more than you would get in a bank account, right? At the time of this recording, the best interest rate you can get in most high yield savings accounts is like 0.5, 0.6%. So getting 9% rate of return on average over 20 years is really, really good. I would be very happy with that. So that's really what you want to look at, is like the longest amount one they have, which is the 10-year, and then since inception. The problem is many of the funds haven't been around over 20 years or even 10 years. So it's really hard to predict with some of them what it's going to look like. That's why I really like the total stock market, because we have had that data here in this fund VTI since 2001 for over 20 years. We're seeing it's right in line with that average 7 to 12% range that we expected, right? And that in the past 10 years, it's been doing super well. So when you're looking at a fund that doesn't have this data, like maybe you only have it from the past year and that's it, it's just harder to predict. So, and that's okay. Like you can make an informed decision looking at other factors, right? But just know that it is a bit more risky because we don't have that data to look at, again, of how it's been over 20 years, over 10 years. So it can be helpful to kind of, especially when you're starting, stick with funds that have been around at least 10 years and looking at the performance rate and seeing how it compares to this. If it's like way under, it may not be the best strategy compared to doing something simple like the total stock market, because, the numbers speak for themselves, right? We want to be making very logical decisions with our investing, not going off emotion, not off of speculation, what we think will be the best. We want to do what we know works. And so that's often why many financial experts recommend a simple approach to investing, of just investing in the total stock market, because of these numbers we're looking at here in that 7 to 12% range that can be expected. Now I'm going to show you the same thing with the index fund version. I'll switch over so you can get an idea. So again, we just click the tab for price and performance. And we go down to here, how it's performed average annual returns right here. So we can see this one's actually really, really similar to the ETF. So the 10 years also, it's been in the 16% range. So very similar performance to the VTI. That's why they're pretty interchangeable, VTI and VTSAX. The expense ratios are pretty similar. The performance rates are pretty similar. And then if we look at since inception, it's pretty similar as well. The ETF was a little higher in the 9% range. This one is in the high 8% range. However, it's been around since 2000 instead of 2001. So that might explain the difference, because it's been around a little bit longer than the 2001 timeline for VTI. So that could explain the small discrepancy. But overall, these two funds are performing at a really similar rate. They're both tracking that expected range of 7 to 12% for the total stock market, over 100 years, and have low fees, are very competitive. So use this as a benchmark as you're making decisions about what you invest in, and as you're looking at other tickers for other investments, to see how they compare in terms of the fees, the expense ratio, and the performance. These are the two of the most important indicators we really want to look at and be making smart decisions when we're investing. Thanks, and let us know if you have any questions.